Hi, I'm Greg Weldon, and we're bringing today a special Weldon Live edition for our YouTube channel subscribers. We're also inviting in our Twitter followers to check this out. Sign up for the Weldon Live YouTube, or hopefully go to our website, or email me directly, or email our Director of Operations, Caitlin Ellis, and sign up for a free 2-week trial to our research. We're going to give you an excerpt, a special edition from today's Weldon Live. We cover global macro, foreign exchange, fixed income, stock indexes, precious and industrial metals, energy, and agricultural commodities pretty much every day. Today, the macro covered India, China, Japan, so we have broad-based coverage. Today, we also include stock indexes. We include the energy markets. And we throw in our trade lab, which is our specific trading recommendations on a big picture in all the sectors we cover. And we monitor these positions every single day, looking for those long-term, big picture trends upon which you can make a lot of money. Now, we've been generally bullish on stocks globally. We're long Poland has been a great position, the kind of second derivative to the German export juggernaut, semi-finished goods exported from places like Poland, Czech Republic, and Hungary to Germany. Part of that, big, strong GDP growth generating dynamic that we see in Europe. Okay, we've been kind of bullish in places like China, in Brazil. There are several places, so we're not kind of gloom and doomers in terms of global stocks. There are some issues there. The decline of CRB is a concern for emerging markets, something we covered in today's live. But really what the point of today's special edition for YouTube is to look at the U.S. stock market. We've been talking about this for a couple of weeks. It goes back to when we became really concerned about the extended nature of the rallies in the tech sector, the high nominal prices against diminished volume, just the $1,000 a share. Who's going to be in there buying tons of shares? Especially if there's a decline in the market and you have everyone that wants to own these shares pretty much owning those shares. I tell you what, it's one of those musical chair situations where you could hit a vacuum of volume, a vacuum of buyers, if you have a significant amount of people that go to liquidate and take profits at the same time. The overall market is our concern here today. Okay, because what we do is, not only do we focus on the fundamentals, global macro, monetary, global central banks everywhere, but then we hone it down to, even in terms of the U.S. stock market, what's the breakdown in the sectors? What do the portfolio dynamics maybe even look like? We include that in our, daily Weldon Live in terms of our trade lab. So we combine the two today here, and we bring energy in at the end to give you kind of an updated overall view of where the U.S. stock market is, in our opinion. And what we see is rising risk of some liquidation, profit taking, and more than that, an erosion in the underlying fabric here in terms of the percentage of S&P 500 shares that are trending bullishly, as we define them by proprietary momentum models, and the percent that are trending bearishly. So let's just kind of take a step back and take a look at just, I've been on a vacation. It's the first one I've had in, 3-4 years. Caitlin was on vacation, my Director of Operations, the week before I was. So, first 2 weeks of August, essentially, we've been out. So we go back to July 31st, about the time we started warning on the tech stocks. And you see, you made a new high. You had an outside key downside reversal day. You probed the 50-day moving average. Every time you've done that in the last 4 occasions, you've bounced back to new highs, okay? But with declining momentum. So this shell game may be coming to an end, particularly when we note, and here it is, 2437 would be a major breakdown that would void this whole pattern of bouncing off a move below the 50-day moving average, not threatening the uptrend line. It goes all the way back to the election in the U.S., let alone the fact that none of those policies that were supposed to spur growth of 3 to 4% GDP in the U.S. are even anywhere near being implemented. Let's talk about the reality of that versus the expectation we see here in the stock market, okay? But let's just look at the pure price action here now, which is kind of sending off some warning signs. What we mean by that is that we follow every day and offer it in Weldon Live every day as part of the overall service, one price, one service. We think it's just great value, research that pays for itself without being unhumble. It really does. The bullish percentage, when we started a vacation here, July 31st, 32% of the S&P 500 stocks were trending bullishly against only 10% that were trending bearishly. That's a net 22 plus. Not bad. Not what you would really expect to see at new highs, if you ask me. Rather subpar, but not bad. Plus 22, 32 to 10. As of today, it's plus 3. Plus 3. A 5-point decline. Virtually nothing when you're at like 2,500. okay? And you have a complete collapse in the percent bullish versus the percent bearish. And not only that, neutral changed from 58 to 57. Some neutral went to bearish. So you've gone bullish to bearish, neutral to bearish, and you've down 9 percentage points here. You're up 10 percentage points here, and the net is now only plus 3, virtually evaporating a big net positive plus 22. Now, where does that come from in terms of the sectors? Well, here was your layout, as we give every day, from July 31st. What was the percentage? It was 159 of the overall S&P would give us our 32%. 52% gave us our 10%. So there's your plus 22. But we break it down by each sector, too. 27 consumer discretionary stocks trending bullishly against 15 trending bearishly. Let's go down to information technology. 29 versus 6. Financials, 35 versus 3. So the financials, as we know, as was the case, I mean, this is, telling us what's going on. The financials were outperforming. The information technology was outperforming. Healthcare was 3-1, outperforming. Industrials, pretty positive 2-to-1 ratio, outperforming. But since then, look at the changes. The number of stocks trending bullishly in the S&P 500 dropped to 118 from 159. That's a decline of 41 stocks. 46 more are positive for a bearish trend and closing the gap to where it's negligible, and thus our plus 3 ratio, up from 52. So that's a 46. Here's the breakdown by sector. Now, an easier way that we show the sectors is in this bar graph. Here's July 31st. The financials, almost 40%, well above 35, and the information technology, 35-ish. The two leading sectors. Where are we today? I mean, nothing's really above 15 except utilities. Talk about a flight to safety. The utilities, the only sector today above 30% net bullish stocks trending in the S&P 500 versus bearish stocks trending out of that sector. That's a big shift. This is telling us a lot. This market is in more trouble than being just down 5 points, than having bounced again off the 50-day, have not violating the post-election uptrend line, not threatening the 100-day moving average. These innards tell us that that's about to change. When we go further, we give every day, if you were to take the bearish stocks and break them down into a portfolio of 100%, what percentage would each sector make up? Okay? Well, here you were. On July 31st, consumer discretionary was by far the largest. Where are you today? Well, consumer discretionary is still the largest, which speaks volumes to my mind to what we've seen in retail sales, what we've seen in a lack of wage growth. A lot of the macro fundamentals playing in there for sure. We've kind of been waiting for the consumer discretionary ETFs to crack. They haven't. But the underlying dynamic there is not as positive as you would want to see it when you have something that's at new record highs. It's just not kind of there. It's kind of fallen off. The consumer staples bearish has halved. Another flight to safety, just like utilities. You go to staples, out of discretionary. The energy has nearly tripled, and the financials have nearly doubled. Okay? And the information technology is actually less bearish because you've gone from bullish to neutral there, more than going to bearish. The financials, one of the real kind of upside leaders here recently. I mean, that's a big shift. Okay. Now, in today's live, just got to add this because in our energy sector, we did look at the breakdown in the energy sector itself. Here's the IYE. I mean, because this is big stuff. I mean, these are major technical levels that are being threatened by the energy shares. Here is the IYE. 34.55 is the low. 34.73 today. Look at how important this is. The 50% of the bigger picture move going all the way back to the post collapse lows. All right, so that's a big level. You violate that level, you're looking at $28. That's 15 to 20% down. This is 18.8% below 34.55. That's a big move, and it's totally in line with what the technicals imply right here. And the fact that the big cap blue chip behemoth of the sector, your real benchmark, ExxonMobil, is cracking wide open. One of the most widely held stocks. Look at the daily pattern. This is a new low. Look at the weekly pattern. Moving averages, increasingly bearish alignment, widening. Roll over here in the long-term oscillator. And look at the close-up. I mean, this is a new year-to-date, new 52-week low in ExxonMobil. And look at the monthly chart. Look at the 15-year, 17-year uptrend line since really 2002. 15-year uptrend line. being threatened, being violated at a time when the moving averages, they crossed here, they almost crossed, they kind of crossed here almost, kind of crossed here almost, and you bounced off this trend line. So we'll see what happens. But you have a different momentum dynamic here, much different. These moving averages are more negative than they were either here or here already, and you're violating the trend line. If you close below it, that's something you haven't done in 15 years. Even here, when you violated and had a really interesting 38% retracement, you didn't close below that trend line. This level is wide open in ExxonMobil, and this is a real ugly looking chart in terms of where this is, and not only that, in terms of holding the ExxonMobil versus holding the S&P 500. Wow, has that been a mistake? You're at your lowest level in 16 years, since 2001, and you're down 50% over the last 5 years, holding Exxon relative to the S&P. Now, of course, this is stuff we do every day. We invite our YouTube channelers and anyone on Twitter, come check us out. 2 weeks free. Check it out for 2 weeks every day. This is what we do. I think you'll find that, given the trading ideas, given the backdrop, given the understanding of the macros, given our technical analysis and blending it all together, connecting all the dots, okay, that this research really is not an expense, it's an investment. It's literally the research that pays for itself. Thanks a lot. Look to see you on our website, signed up for a free trial.